Welcome to our explainer. Today, we're going to connect the dots, all the way from a single decision made in Washington, D.C., to the huge ripple effects it's having thousands of miles away, right in the heart of the Indian market. It's a great question, isn't it? In this totally interconnected global economy we live in, just one move by a central bank can kick off a chain reaction that literally crosses oceans. And that is the exact story we're going to unpack today. And this is where it all starts, with what looks like a tiny number, negative 25 basis points. You can think of this as the splash that starts the ripple. The U.S. Federal Reserve just cut its main interest rate. So what in the world does that actually mean for the markets? Okay, so first things first, let's dig into what the Fed actually announced, because, the devil's always in the details. The Fed's announcement was, well, a classic mixed message. That 25-point cut? Pretty much everyone saw that coming. But the real news, the thing that got everyone talking, was the hint that 2 more cuts are on the way this year. So even though they mentioned being worried about the job market, that promise of cheaper money down the road, that was music to the market's ears. All right, so the Fed has made its decision. And almost immediately, that first ripple starts to travel across the globe. And it's all about where huge amounts of money are going to go next. So how does this actually work? Well, picture it like a set of dominoes. The Fed cuts rates. Suddenly, super safe investments like U.S. government bonds just don't pay as much. Now, if you're a huge global investor, what we call a foreign institutional investor, or an FII, that's your cue. Your capital starts hunting for a better payday, and it often flows towards high-growth places like emerging market. And that's where India enters the picture. All that money looking for a new home could very well land in Indian stocks and bonds. This does 2 things. 1, it boosts the market, and 2, it actually makes the Indian rupee stronger against the US dollar. So yeah, a decision made in an office in the US can directly lead to more cash flowing into India. So that wave of global money washes up on India's shores. And that doesn't just affect the stock market. It creates a massive opportunity for India's own central bank, the RBI. It's really important to see the 2-step effect here. The direct hit is all that money flowing in from those FIIs. But the indirect effect, and honestly, maybe the more powerful one, is the freedom this gives the Reserve Bank of India. See, think about it. If the RBI cuts its rates while U.S. rates are high, it's taking a big risk. Money could fly out of India to chase those better returns in the U.S. But now that the Fed is cutting, the RBI basically has a green light. It can go ahead and cut its own rates to help the Indian economy grow without having to worry so much about that money leaving. And that's exactly why so many people are expecting the RBI to cut rates in October and then again in December. Right after the Fed's announcement, the Indian market did something pretty unexpected. It had this sharp V-shaped rally. A huge reason for this is something called short covering. Basically, a lot of traders had bet that the market would go down. That's called going short. When the news from the Fed was better than they feared, all those traders had to rush to buy back shares to limit their losses. And that sudden frenzy of buying is what created this powerful, even if temporary, surge. Okay, so we've got central banks in both the US and India looking like they're going to be cutting rates. So the big question is, who are the winners and losers from all this in the Indian economy? We can actually trace the impact of these rate cuts pretty clearly. For banks and other financial companies, what we call NBFCs, this is fantastic news. Their borrowing costs go down, which means they can lend more and make better profits. Real estate gets a similar boost. Cheaper home loans mean more people can afford to buy. And on a global scale, when rates are cut, it often gets the economy moving, which increases demand for stuff like gold and silver. The IT sector, though, that one's a bit more complicated. Sure, rate cuts mean their clients might spend more. But at the same time, the rise of AI could mean that new projects are just smaller. So it's a mixed bag for them. But there is a huge shadow hanging over this whole optimistic picture. There is one major wildcard here that could change everything. Those tense trade negotiations happening between the United States and India. Now this is the official hopeful line coming straight from the Indian government. The chief economic advisor is painting a very rosy picture, suggesting that these harsh tariffs from the U.S. will go away and a good deal is right around the corner. If that actually happens, it would be a massive boost for the Indian economy. And here's the reality check. The U.S. has been really clear about what it wants, especially better access for its farm products in India, and for India to stop buying Russian oil. The more skeptical view here is that it's just highly unlikely the U.S. will back down on these key points without getting a major win in return. So this leaves us with the billion-dollar question. Can India actually get the deal it wants without caving on these major issues? Seriously, everything from foreign investment to what the RBI does next is hanging in the balance. For now, the market and all of us can really only wait and hold our breath.